All right. Today we're going to talk about something different. Today we have the economy, where we at, especially in Canada over here, market isn't doing too good. If you haven't heard already, Trudeau is pausing 2 month GST HST tax. I don't know if it's gonna make much of a difference. Obviously, it will for that period. I don't know what's it gonna be like after that 2 period phase, a 2 months 2 months phase. But this is about like why is Canadian dollar doing so bad in comparison to US dollar, because right now it's at 70 cent a dollar, which is not too great.
The Canadian dollar is now
Let's
at
see.
its lowest point since peak pandemic. Before that, the last time it
Okay.
fell below 72 cents US was almost a decade ago. And everyone we
Hmm.
spoke to expects it's still got further to fall.
We've seen the losses essentially accelerate in recent
Because
weeks.
no new companies are coming in. Like there's no new investments that are coming in. That's an
will
issue.
feel that in their pocket.
Now, look, maybe you're thinking, I have no plans to travel to the US. Why do I care? But even if you never leave your neighborhood, the exchange rate absolutely affects you. So let's go through how, starting with how the dollar fell so low in the first place. There are a few things that go into how the value of a currency is determined, but at its core, it's about supply and demand. If people or businesses
Exactly.
around the world want to buy products, stocks, or real estate from a country, they typically need that country's currency to do so. That increases demand for the currency and can drive up its value.
The exchange rate is the price of one currency in terms of another. And so if you need US currency, that's going to drive up the value of the US dollar, which means then, relatively speaking, the Canadian dollar is going to weaken.
Generally, there are two big selling features that make investors want to put their money into one country over another. One is if they believe that country's economic outlook is trending in the right direction. If the American economy is doing well, you might.
I mean, it's gonna go amazing.
Right? And right
We can
now,
already see
there's
the
a pretty
stocks
big
going
difference
up.
between the Canadian and American economies.
One of the stark divergences we see in Canada versus the US is, number one, the economies are moving in two different ways.
For example, the unemployment rate in the US is about 4%. In Canada, it's been creeping up. Now it's 6.5%. GDP growth last quarter was close to
In
3%.
Ontario,
the
it's
US.
probably more.
In
It's
Canada,
probably
it was around
15%.
1%. And the debt to income ratio in the United States, that's how much of your gross monthly income goes to paying debt, is around 100%. In Canada, it's 180%. That means
Damn.
more debt than income. You get the point. Economies unequal. But the other big reason investors might want to put money into
Even 100 is bad.
is when it's
180
got
is
high
awful.
interest rates.
If like an international investor has money to invest in either Canada or US, all
That's
else
awful.
equal, they'll gravitate
Because basically you
where the
can't
interest is
ever
higher
pay your
because they
debt.
earn more.
And so that's unquestionably at this point in the United States.
Canada has been cutting
Jesus.
rates over and over again since the summer, trying to kickstart a stalling economy. Meanwhile, in the US, with a much stronger economy, their rates haven't moved as much. So far, they've only cut 3/4 of a percentage point off their policy rate to Canada's 1.25 percentage point.
Well, we don't have to move in lockstep with each other. We tend to. But on this particular occasion, we haven't.
Now, there were signs that the US was going to start cutting interest rates more aggressively too, which would, in theory, help take some pressure off the Canadian dollar. But just a few weeks ago, the entire economic landscape changed.
Yep. It just went
President
so
Donald Trump
amazing.
has a very different economic plan than Joe Biden. He's promised to slash taxes, deregulate, boost spending, and put in some pretty hefty tariffs. All of that has markets predicting a boost in growth.
The market's reaction to Donald Trump's victory has been.
Bro, they were saying the opposite
Like
before the
just about every
election.
other
What the fuck?
currency was down against the US dollar.
What his platform was is very nationalistic, pro-growth, pro-US.
Yeah, of course.
So that's the type of thing then that's going to make people want to put their money into US shares and into US investments. And so in order to do that, you need US currency.
And this new reality prompted the head of the Federal Reserve to signal that US interest rates may stay higher for longer than anticipated, meaning that gap between Canadian and American interest rates is now expected to widen even more, sending the Canadian dollar even lower.
The US dollar is uniquely strong right now because just 2 months ago we were pricing in rapid US rate cuts, and now the market has turned around and said maybe they'll only cut, a half point, 3/4 of a point over the next year, whereas Canada might cut by a half point next month.
All of that is accelerating what we're seeing in the currency markets and helping to drive the Loonie.
Why is nobody talking about why there's no investments coming in?
If you're a Canadian planning to travel to the US over the next little while, you are certainly going to feel the pinch. Say, for example, you're budgeting $200 Canadian a night for a hotel. At 71 cents on the dollar, that's only $142 US, which could be the difference between a 3-star hotel and a 2-star hotel. So you can imagine at least some Canadians are thinking twice about their trips down south this winter.
There's an entire set of the population that does not hang around in Canada during the winter. They might find that it's a lot more difficult to go to the US.
Going to visit a major US city or going to
Go to Mexico.
Florida in the winter is just going to be painfully expensive.
But a weak Canadian dollar...
Because it's literally the same thing. Not same, but it's different.
Impacts that are also much trickier to avoid.
So anybody walking around with an iPhone right now, or anybody who's buying fruits and vegetables at the local grocery store, is probably importing it from the US.
Next time you buy a book in Canada, take a look at the back, and often the price you'll see is in both Canadian and US dollars. It's a pretty good reminder of just how much more Canadians pay for the exact same product. My producer bought this book a few years ago when
the
dollar
thing
was
is,
in a
the
better place.
income
There's
is
about
lower
a
than US.
26% difference.
That's the big issue
between
as
the
well.
US
Like,
and Canadian
they're not
prices.
making
But
more money
if you want a
here.
brand new book published today with the Canadian dollar
I
at
don't know.
71 cents US, you could be paying around 40% more. Now, extrapolate that out to everything Canada imports from the US, which is hundreds of billions of dollars worth of goods each year, and you can start to see how hard it becomes to escape the impact.
How much are we
You would find that all of a sudden
exporting?
the food prices,
I don't know
technology
that number.
prices, or anything that you're buying from the US has now gone up in Canadian dollar terms.
But it's the impact on businesses, especially smaller businesses, that worries the economists that we spoke to most. Say your family runs a corner store in Hamilton, and a few years ago, you budgeted around $5 a pint to import California strawberries. But as the dollar's gotten weaker and weaker, you're now paying the equivalent of about $6 a pint. So what do? Well, you could pass the extra cost onto the consumer by raising prices. The problem with that is if you jack up your prices, you could risk losing your customers to big box grocers like Loblaws or Sobeys, because those big box grocers can usually prepare for these kinds of fluctuations. They've got bigger supply networks, so maybe they import from Chile instead of California. They're also able to negotiate set prices for produce, sometimes a full year out, so they can often keep the price of their strawberries relatively steady.
If you're smaller and you're more local, you're kind of at the whim of all the things that you can't control. You can't
Yeah,
manage.
they probably have their
Depending
own
on how long
farms.
this
Not
lasts, it really could do some damage, especially to smaller Canadian businesses that are very reliant on American inputs.
Inputs, meaning everything from the machinery a business uses to the parts that they're sourcing to the staff that they hire. So just think about all the North American sports leagues that have a team in Canada. All of their revenue from ticket sales, sponsorships, broadcast rights, they get all of that in Canadian dollars, but they pay their athletes in American dollars. When the Canadian dollar gets weaker relative to the US, those players' salaries can feel a lot more expensive. Now, teams also use the same kinds of hedging strategies that those big box grocery stores do, but it's still a challenge that they have to work around. In fact, if you look back 3 decades ago, when the dollar fell to around the same value that it is now, even slightly lower actually, Canada
3
lost
decades.
the Quebec Nordiques to Denver, Colorado, and a year later, the Winnipeg Jets left too.
Winnipeg may have tradition on its side, but Phoenix is something else. It has money.
Now, to be clear, there's a long list of reasons why these teams left, but both owners cited the low Canadian dollar as one of them.
Sometimes Canadian businesses just decide the best way to avoid this problem is to leave entirely.
And here's the real kicker. What happens over time when things become more and more expensive?
A weaker Canadian dollar means you import more inflation.
That's right, inflation. Something we're already starting to see sneaking its way back into our lives.
Canadians having just gotten over inflation, starting to reckon with cost of living affordability issues, might find that these things start to creep back again. And it might actually force the Bank of Canada to slow down the interest rate cuts, pause the interest rate cuts, or worst case scenario, even start increasing interest rates again to try and keep inflation from rearing its head again.
So we talked about how Canadians might want to start postponing their American road trips. Well, the flip side is also true. If you're an American, it's a great time to come to Canada.
How many Americans are now going to look at Banff or Mont-Tremblant or the Atlantic Canadian provinces and say, man, I always wanted to travel there. Now is a great time to do it because my American money is going to travel really far in Canada.
This applies to some industries too. So say you're a production company looking to shoot a rom-com in a quiet mountain town, and you're trying to cut down on your production fees like hotels, meals, car rentals. Canada starts looking pretty attractive. And more travelers, more film crews, that's great news for local economies.
There's a number of areas where it would benefit in regards to increasing the income and growth that comes into Canada.
This same logic also applies to anything made in Canada that's sold to the US at Canadian prices. With a low Canadian dollar, important Canadian products like oil, auto parts, lumber, they also become cheaper and more attractive to Americans. So in theory, exports could grow.
So you have your car manufacturers, your steel, a lot of heavy manufacturing. If you're a US company looking to buy goods, all of a sudden you'll look more at Canada now because it's cheaper for you to do.
But here's the thing. If Trump follows through on his promise to put a 10% tariff on international goods, Canadian products will suddenly become a lot more expensive, which could completely cancel out the benefits of a lower dollar. In fact, according to economists at TD, we could actually see a net 5% reduction in Canadian exports to the US in the next couple of years.
If any country in North America is tariffed or negotiated or carved out of the US supply chain, you are essentially losing access to one of the world's most productive and efficient and biggest markets.
It's a bit of a moment when it's the worst of both worlds for Canada with a weaker currency.
And so, currency traders are taking a much more skeptical view on where the Canadian dollar is going.
Now, everyone we spoke to said maybe the most concerning thing about a Canadian dollar that struggles against the US dollar is what it says about Canada. It's a lack of confidence. So the prospect of falling even further below 70 cents US, as many are predicting, it could be an issue.
Jesus. I mean, think of it this way, like right now, the US had a great win for economy. Canada needs such a great win for economy. They need that kind of policies which are going to put them again on a place where there's more attractive pieces to it, right? Like right now, the job market isn't doing good. The economy, again, linked to the job market, is not doing good. The overall just social, I guess, life is not great at the moment. I mean, it is, but only in the cities, or few chosen cities, actually. So yeah, there is a long way to go, and the next year is gonna be a really challenging one, especially for Canada, because the election is also next year as well. So that's gonna be an interesting one. And I also am intrigued to kind of like see how these no GST, HST for 2 months gonna sit down as, like how the price is gonna change of the groceries and other essential goods as well. So that'll be interesting. Let me know what you think about it, and I'll catch you in the next one. Take care and stay safe.